Welcome back to the deep dive. Today, we are taking a really close look at the Q3 2025 results from Amer Sports. And look, if you still think of this company as just, winter equipment or tennis rackets.
You really need to recalibrate that view.
Exactly. Our sources, the reports, the commentary, they all tell a story of a radical strategic pivot.
A huge pivot. This is not a sports equipment company anymore, not really.
It's becoming a premium apparel and footwear house. A soft goods surge, you could call it.
I like that.
So our mission today is to unpack the sheer speed of this growth, get into the two main engines, Arc'teryx and Salomon, and really understand how this direct-to-consumer model is working for them.
And that model is backed up by some really exceptional numbers. Amer Sports didn't just meet expectations in Q3.
No, they blew past them.
They sailed past them. Group revenue increased a very robust 30% year over year, hitting about $1.76 billion.
And it wasn't just a fluke.
Not at all. It's systemic. And management seems very confident this momentum is carrying right into Q4.
Okay, so let's get into that success story. A 30% revenue jump is fantastic, but, we're always looking for high-quality, profitable growth.
Right.
Where did they really squeeze the most efficiency out of the system?
Well, that's it. The profitability story is arguably even more compelling than the top-line growth.
Is it?
Yeah, definitely. This is where you see that premium positioning in the DTC channel just really shine.
So the bottom line.
The bottom line. Adjusted diluted earnings per share, it jumped a massive 161% year over year.
Wow. 161%. From what, 14 cents to 33 cents?
Exactly. From 14 cents in Q3 2024 to 33 cents in Q3 2025.
That is an incredible jump. It suggests they're not just selling more stuff. I mean, they're either getting much higher prices or managing costs brilliantly, or both.
It's both, and it looks structurally supported. It's not a one-time thing.
Okay.
It's mainly driven by that improved sales mix, selling more of those high-margin Arc'teryx jackets and Salomon shoes, and yes, the pricing power from the direct channel.
You can see it in the margins, I assume?
Clearly. Adjusted gross margin was up 240 basis points, landing at 57.9%.
Almost 58%.
And that flows right down. Adjusted operating margin increased 130 basis points to 15.7%.
So expanding margins while accelerating sales, that's the dream, isn't it?
That's the sign of a structural tailwind, not just a temporary spike.
That makes the model look very strong. But if we look at where the sales are coming from, geographically, a lot of the excitement seems to be concentrated in Asia.
That's a critical observation. I mean, the success was widespread. All four regions had double-digit growth.
But Greater China.
But Greater China is undeniably the star. Phenomenal growth of 47%. And APAC as a whole was up 54%.
That 47% growth is huge, but it comes with risk, right? Yeah. Is there a danger of over-relying on a single market?
That's the key long-term question. But the sources suggest their strategy is to hedge that risk through channel control.
Meaning their own stores.
Exactly. Because they're focusing so heavily on direct-to-consumer, on own stores and e-commerce in those regions, they have much better control over pricing, brand image, inventory, all of it.
That sets the stage perfectly then. Let's dive into those twin engines that powered the quarter: technical apparel and outdoor performance.
The two big ones.
Let's start with technical apparel, which is basically Arc'teryx. Revenue was up 31% to $683 million.
Arc'teryx is it's the definition of a breakout brand right now.
Yeah.
And the standout metric this quarter was the omni-comp re-acceleration.
Okay, let's define that. Omni-comp is comparable sales from their existing physical stores and their own digital channels. It's a measure of efficiency, really.
Precisely. And that figure re-accelerated strongly to 27% in Q3.
Which is way up from the 15% they posted in Q2.
A huge jump. It's a massive indicator that the brand heat isn't fading at all. It's actually building. This whole Gorp core trend, this move into high-end lifestyle fashion, it's really working.
And when we look at their distribution, the DTC strategy is clearly the main fuel source.
Oh, absolutely. The DTC expansion fueled Q3 growth by a staggering 46%.
46.
Yeah. And you compare that to just 11% growth in wholesale. I mean, the strategic priority could not be clearer.
And they're expanding their footprint, especially in Asia. 4 new stores in Q3. But let's talk about that Korea acquisition. That feels like a major move.
It's a very decisive move. They bought their longtime Korean distribution partner.
So they're taking it in-house.
Exactly. And while the financial impact was small this quarter, the forward impact is huge. That business is expected to generate about $120 million in annualized sales for 2025.
So they basically just bought a mature, high-spend market presence overnight.
Yep, bypassing all the friction of building it from scratch.
Now, I did notice one little thing, a slight margin contraction in this segment. The segment operating margin declined 100 basis points to 19%. What's that about? Is it just noise?
It's a really important nuance to catch, and yes, it's largely accounting noise. Specifically, it's about a timing shift related to some government grants.
Explain that timing shift. Sometimes that sounds like an excuse for an operational slip.
That's a fair skepticism to have. But here's the detail. The benefit of the grant was recognized in a prior quarter, probably Q2. But the costs associated with earning that grant hit the books in Q3.
I see.
So it created this temporary non-operational headwind. Management calculated it as about a 125 basis point drag on the margin.
So without that, the margin would have actually been up.
It would have been up. We expect it to normalize next quarter. The underlying profitability is very strong.
Perfect. That distinction is critical. Okay, let's turn to the second massive pillar, outdoor performance. Salomon.
Right.
This one was growing even faster. Revenue up 36% to $724 million.
This segment story is all about transformation. This is the soft goods shift, where Salomon is intentionally pivoting from equipment skis, hard goods, to footwear and apparel.
And what does that pivot look like in numbers? It must be a huge undertaking.
The change is radical. In 2022, the segment was 54% equipment. Management projects. That by the end of 2025, it'll be 72% footwear and apparel.
Wow. That is a massive strategic transition.
It's what's powering this incredible growth. They're meeting that huge global demand for technical lifestyle footwear.
And it seems like Salomon footwear is where they see the really long runway. They said it still only has a small share of the global sneaker market.
That comment is a goldmine. It tells you they think they barely scratched the surface.
Yeah.
They're leveraging that trail running authenticity into the much bigger casual sneaker market. They are nowhere near saturation.
And just like Arc'teryx, the DTC engine for Salomon is running hot. Even hotter, actually.
Even hotter. DTC grew 67% in Q3. And that translated into massive financial power. Adjusted operating margin expanded by 420 basis points to 21.7%.
And that's driven by new stores?
Yep. 29 net new Salomon stores opened in Q3 alone, heavily concentrated in Greater China, Korea, and Japan. Put the product where the growth is and sell it directly.
Okay, so we have this explosive growth in technical apparel and this explosive transformation in outdoor performance.
Just huge momentum.
So let's shift gears a bit to the third pillar. Ball and rec sports. Wilson.
Right. A bit of a different story here.
Slower, for sure, but still showing some really strategic wins.
Absolutely. I mean, revenue was up 16% to $350 million. For a mature heritage business like that, 16% is a really solid result.
So what were the specific successes there?
The growth came from their racket sports business, really. They talked about the momentum from their Wilson Tennis 360 platform. The memorable detail was that the U.S. Open was their strongest ever.
Right, with Arina Sabalenka winning with the Blade B9, that kind of visibility helps.
It really does. It shows the hard goods legacy is still generating a lot of buzz.
But just like the other segments, the future upside here is in soft goods, isn't it?
That's the strategic challenge and opportunity. Wilson Soft Goods, which doubled in 2024, is targeted for significant growth potential.
How does their approach differ from Arc'teryx, which is all about high-end technical gear?
Well, Wilson is focusing more on athletic lifestyle wear that leverages its authenticity in sports like tennis and golf. They're trying to build a lifestyle presence that mirrors their core sports.
That makes sense. But the sources also mentioned that soft sales in baseball and inflatables kind of drag things down a bit.
Precisely. They're managing a very mixed portfolio. Some traditional categories are just inherently slower. The strategy is to use the equity from the rackets and the golf clubs to drive adoption of the higher margin apparel.
And they're using the same playbook to do it.
Exactly the same. Following the DTC model, opening 10 new Wilson stores, mostly in Greater China, replicating that channel control.
So if we pull back for a second, we've established that the premium brands and the aggressive DTC push are the drivers.
Right.
These Q3 results aren't just a lucky quarter, they reflect these intentional shifts.
The channel strategy is fundamentally reshaping the whole company. Overall, DTC grew 51% in Q3, while wholesale grew just 18%. That gap, that's their biggest competitive advantage right now. They're cutting out the middleman, and controlling the brand experience.
And we really can't overstate the regional story here. Greater China and APAC are just delivering spectacular returns.
Absolutely. Greater China, with its 47% growth, is delivering best-in-class performance across all three big brands,
All three.
Arc'teryx, Salomon, and Wilson. It shows that the Asian consumer is highly responsive to this kind of curated high-end retail experience.
So given all this momentum, what is management telling us to expect for the rest of the year? Did they raise guidance?
They did. Confidence is high. They raised the full-year guidance significantly. They're now projecting reported revenue growth of 23 to 24% for all of 2025.
And for EPS?
For adjusted EPS, they're guiding to a range of 88 to 92 cents.
And I assume the segment targets show that the soft goods powerhouses are expected to keep leading the charge.
That's right. Technical apparel is guided to 26 to 27% growth, with high margins around 21%. Outdoor performance is targeted for even higher growth at 28 to 29%. The core engine is built for sustained speed.
And what about the long term? What's the 5+ year algorithm they're pitching?
Over the long term, they're targeting a group revenue CAGR in the low double-digit to mid-teens range.
And critically.
And critically, they anticipate annual adjusted operating margin expansion of 30 to 70+ basis points year after year.
So, quality growth. They're betting the DTC structure and the shift to soft goods will just systematically improve profitability.
That's the bet.
So, to kind of wrap this all up then, Amer Sports' exceptional quarter really boils down to two primary forces, doesn't it?
I think so, yeah.
First, you have the just incredible brand heat and high margin performance of Arc'teryx.
Absolutely.
And second, that really successful, really strategic pivot of Salomon, turning it from an equipment brand into a footwear and apparel powerhouse. And both are just supercharged by DTC.
Right. And this quarter just crystallizes that shift in consumer demand. People want highly technical, innovation-driven stuff that works for performance, but also fits their lifestyle needs.
Yeah.
The future is soft, profitable growth.
Indeed. We noted that two of their strong established segments, Wilson Equipment and Winter Sports, already have leading market shares and are expected to deliver slower growth.
Right. They're mature.
So given the rapid success Arc'teryx and Salomon footwear have had in capturing new consumer segments, the question for you to mull over is this. Management is targeting massive scale with this new apparel focus. So what's next? What specific adjacent lifestyle category beyond mountain gear and tennis is next for these premium brands to disrupt and seize market share? Are they eyeing urban cycling, luxury travel accessories, or maybe even a whole new definition of high-performance business wear?